Hey, Jason, welcome. How are you today?
I'm good, Eitan. Thanks for having me, man. Glad to be here.
Yes, it's a pleasure. Thank you so much for being here with us as well. So, Jason, how do you see? I mean, you've been working with brands so much. I mean, how do you see the market these days?
Oh man, how much time we got? Couple hours at
Yeah,
least.
we need the,
It's
the the interesting shorter version, please.
yeah. Well, it's an interesting market right now. Again, obviously we work with brands all over the world, but we are sort of U.S. somewhat focused. So I think a lot of what we're seeing is kind of U.S. I'd say oriented. A lot of my comments will be U.S. Oriented. I think we're going through a transition period. I know you and I were sort of chatting about this a little bit before we got on air. Especially look, I know a lot of what we talk about is direct to consumer, but we sort of just look at consumer holistically a little bit. Because that's really what it's become. I think we had this weird period, and not to give your audience a history lesson, I'm sure they know, but if you look at the history of e-commerce, you sort of had this steady, rise from 2008, 9, 10 up through 2020. Pretty steady, 10% kind of growth a year. It started a little quicker, but then the pandemic, obviously things went sort of haywire,
Yeah.
and we had a massive amount of growth. And then post pandemic, we've had some serious, I'd say, contraction. Although the top line numbers don't really tell that story. I mean, you can see in the data, if you look at e-commerce as a whole, you can see it coming back to down a little, but still as a percentage of retail sales, it's growing. It's a lot higher than it was in 2019, right? Pre-pandemic. And so overall, it's continuing to build market share. What's happening inside of it, though, is a little bit of what we call like a dogfight, right? Where you've got a lot of competition. The competition hasn't figured out yet, especially in 2024. What's my efficient way to build my marketing funnels? I mean, obviously, it's all different depending on your product type, what your value prop is to the customer, what you're really speaking to as a brand. It's interesting because we see a lot of acquisition costs going up. I'd say that's a very common theme right now, and a lot of it is because a lot of direct consumer businesses got very used to building their brands on Facebook using that advertising. That's not the same animal anymore. It's still probably the best platform for scaling, but you have to approach it differently now than you ever approached it in the past. That's for sure. So
So, yeah.
interesting.
So, what has changed? Why is it
Well,
different?
first of
Which,
all, the cost has changed. You say, well, how did the cost change? Right. Well, usually it's economic forces. Supply and demand drives cost. Well, you have a lot more demand. A lot of it came again post pandemic, where you had a lot of brands who weren't spending as much money online, shifting their ad budgets online. That created more, competition for CPMs, obviously trying to get in front of consumers. At the same time, you were coming off of the whole Facebook, iOS 14 change. So targeting those customers is not as easy as it was in the past either. So that's the first thing, right? It's more expensive to get in front of customers through digital channels, and that's probably the biggest driver, right? I think the other one, I'd love to hear your thoughts on this too, is our consumer when they're online, they're more bombarded than they've ever been, right? And so the things you're going to do, especially to generate interest from a new consumer, they're going to be different. They're seeing a lot more options than they used to. They're also just, I'll be honest, it's they have a little fatigue as well now after so many years of being online and just getting hit with ads constantly.
Mhm.
They're kind of numb to a lot of things. So it's harder to get their attention. That's for sure.
Yes, I totally agree. I mean, we know we can identify that someone wants to sell us something within a second, right? And we just swipe up and continue, right? I mean, there is no tolerance for pitches anymore. I mean, sales pitches, and yeah, I mean, also for the marketeers themselves, it's getting more expensive, as you said, on a Meta environment, but also on an Amazon environment, right?
Hmm.
So,
For sure. Yeah, Amazon's interesting, man. I mean, I don't know. Again, the way we look at Amazon, we come across a lot of Amazon native companies. We tend not to work with a lot of Amazon native companies, but we
mhm,
definitely work with some. I think the way we look at Amazon is the same way we look at any other channel in terms of a customer's overall sales portfolio, but it has to be dealt with in a particular way, right? I mean, Amazon is so large, they have so much of the customer's eyeballs, so much of the market share. And like the way you operate on Amazon is different than the way you operate on a pure sort of Shopify or whatever direct consumer channel or bricks and mortar, like how you might market to get customers in a store to buy your product. How you do it on Amazon, it's its own thing. That's why you have to have a very specific strategy, but it's got to play well with the overall strategy too.
Yes, it seems that any of these channels, and we'll probably talk about TikTok and also YouTube now,
Hmm.
and it becomes
Yep.
probable. I mean, it's like different communities that requires different type of expertise. There's no one who is an expert in every aspect of the business, right? You need expertise, you need the right agency, the right service providers to support you. But just to put things into context, tell us about GW Partners.
Yeah, absolutely. Thanks, man. So GW Partners, we're basically a boutique advisory firm. And the way that we work with our clients is it's as if you took a business consulting type of practice and an M&A advisor and you put the two together. So what we love to do is we engage with clients usually 1 to 2 years away from where they'd like to execute a strategic transaction. Now that might be a full sale. It might be just taking on a large growth partner. It could be a few things. More often than not, it's a full sale. But and then what we come in and we do is we become very active in the business. We sit alongside the founder and say, all right, well, what do we need to do for this company so that it looks the way we all want it to look in 1 to 2 years? And so whether that's every function of the business from HR to legal to product development to IP to marketing, all up and down, every function of the company, we get involved and say, what do we need to do here? And then you zoom back out and say, how does this all work with a broader strategic picture so that we can evolve this business into what it really can be? And founders really like it, man. I mean, I think what we find is a lot of founders, even really successful ones, they feel lonely. They feel like they have gaps. They're wearing too many hats. They just love to have people come along who have experience and who have a passion for their business like they do to help them get to, kind of that mountaintop. And so that's what we do, man. We do it. We're a boutique. So we're only ever working with probably say 10 to 12 clients at a time. We have kind of these cohorts where we'll have, say 4 or 5 that might start every given year,
Mm-hmm.
and then every year we might be bringing 3 or 4 to market, right, for some kind of a deal. And so we used to be a pure M&A shop. Like we were just transactional. We did a bunch of sell side deals for about
Mm-hmm.
4.5 years, and then we kept saying to ourselves, if we could only work with these companies early, we could have such a big effect on the outcome. We finally started to, stop just talking about it and actually do something about it. And we changed our model a couple years ago, and we love it.
Interesting. So you work with founders who are looking for some kind of a majority equity deal, right? But you go
Both,
there.
actually, yeah. Most are majority, but then
Yeah.
we've done deals where they want to say, hey, I think if I bring the right 20, 30% strategic partner in the business,
Mm-hmm.
that's going to help me. I'm not ready to give control up. I'm not ready to completely exit, but I'm ready to sell equity to the right party, and they can really help me go and really kind of the next 4 or 5 years go from say a $20 million company to 100.
Yes. But as GW partners, you go there probably earlier, right? You're involved in the company in any of
Very
the
much so.
aspect, like the IP
Absolutely.
side, the legal side, maybe the marketing, supply chain. Try to contribute on knowledge across the various aspects of the business in order to align probably resources more focused on the North Star or the transaction that you're trying to put in place, right? For the
Absolutely.
within 12 to 24 months, this is usually the turnaround time.
Usually is. Yeah. That's
Yeah.
kind of the window that we tend to work with.
Mm-hmm.
Yeah, a lot of it we're getting in and just kind of rolling our sleeves up and doing the work ourselves. Sometimes we're bringing in our just really well vetted strategic resources that over the 7 years that we've been in this market, we've been able to develop really good relationships where we know if we aren't going to actually perform a function, we know a great party who can and who will fit well with the strategic team, which I think is always a very big concern.
Hmm. Now, in terms of your investment or your involvement criteria, is it like niche related, or what are the prerequisites, or what are the parameters of a brand that you're interested in?
Yeah, I mean, I would say our sort of guardrails are we'll go down to about 5 million in revenue, kind of on the small side. We've worked with $100 million brands, kind of on the upper side. Our
Hmm.
average tends to be around 10 to 15 million is when we're work starting, and then we're looking usually to double or triple that. In the next call it 1 to 2 years. Obviously, big, it's not just a revenue story. Revenue's honestly a lesser story these days than profitability, which is a more bigger focus for sure. But yeah, and as far as product types, we worked with all kinds. I mean, we've run the gamut there. We don't shy away from a product type. We have a lot of knowledge and resources across all consumer. We do spend a lot of time in health and beauty. We do spend a lot of time in juvenile for sure. We've got a lot of roots in baby and in health and beauty. So I'd say those are probably our two
Got
biggest
it.
sectors. We also have a lot in apparel lately as well. So yeah, pretty big range.
So, what are the current market conditions, valuations? Obviously, we're not in the pandemic stage, and even just a plan to go to launch on Amazon.
Yeah,
Executed, EBITDA multiplications of 10 or 10, 20. Definitely,
right.
we're in a different era right now. So tell us a little bit about what you see in the market right now. How a success story look like in terms of M&A transaction deal?
Sure. Yeah, yeah. So I'd say, I mean, the market right now is it's again also in a little bit of a transitionary phase from an acquisition standpoint. We saw 2023 was a very, I'd say, low year for
Hmm.
acquisitions. So far, 24 it stayed pretty low.
Yeah.
The valuations peaked in 2021, and we're probably down 30-40% from that peak. I would say, kind of on a comparable basis. And right now it's really about, do you have the right attributes in order to get I'd say a reasonable transaction complete. So it's become a little more binary as well. So there's a lot of capital that would love to do deals, but it's very, very picky about the kinds of acquisitions that they want to do. And there's a lot of concern again around, especially the U.S. consumer. How are they going to behave? Can we scale and not have our acquisition costs, just go
Hmm.
crazy? These are a lot of the focus areas, right? So
Yeah.
now, if we're talking about a lower middle market, kind of direct to consumer brand, say under 20 million of revenue, if you have really good metrics all up and down, your P&L, so your contribution margin, your gross product margin are all good, your EBITDA margin is good, you're still looking at probably 6 to 8 times EBITDA is kind of that's a good valuation for that
Yeah.
size. When once you start getting much below 2 million of EBITDA, you're going to be down more in that 4 to 5 kind of range. You're going to be treated with that smaller sort of company discount. Um,
This
but
is because
there's a lot.
yeah,
Go
because
ahead.
because it didn't prove yet that you can scale beyond that, or just
Yeah,
too
and there's also
risky at
just
this
more
stage.
risk.
Yeah, more risk. Yeah.
Yeah, there's more. There inherently there's more risk in a smaller brand. It's easier to kill a smaller brand than it is to kill a larger brand.
Yeah. It used to be
More
an
often than
opportunity,
not,
now it's a risk, right?
it is absolutely, yeah.
Yeah.
But there's a lot of brands thriving. We're working with a couple clients right now. One in beauty, say one in juvenile, actually, that their growth rates are very high, profitability very high. They're getting approached all the time. To try to be acquired, and it's because they're in that top quartile, right? And again, that top quartile valuation is going to be in that sort of 6 to 8, kind of times if
Mhm.
you're under 5 million of EBITDA. If you're kind of that 2 to 5 range, and that's a lot of where we spend time. We have one client now that's 15 million of EBITDA, and it's getting valued at 10 times.
Mhm.
So larger. And there's a good example. There's been in the middle market, the consumer kind of direct consumer deals that have been done this year. They're kind of in that 10 to 12 to 13 times once you get up into the few hundred million and above. So, but it's really now about being able to prove that your brand has staying power, So a lot of focus on, repeatability. That's why you see beauty and food and beverage having the most activity right now,
Yeah.
because they're the highest level of repeat purchase type
Yeah.
products.
Subscription and more focus on retention, right? So
Right. So what buyers are doing is saying that I can actually see that the customers here are brand loyal. I don't have to guess, right? I can see it because if it's a high repeat type product, I can see that the repeat order rates are either at or above benchmarks. Things that are less, more one time purchase type products, they're less willing to predict the future on those, right? And those are getting a little bit less, I'd say they're less favorable at the
hmm
moment for
hmm
sure. Now
hmm
that's very cyclical. We'll see. But because I think what we're also seeing at the same time is this is not a secret, and people know that there's going to be this period where they can probably, if they're able to complete a purchase now, they're going to be pretty happy about it in a couple years because the valuation point now is pretty good. So
yeah.
I get calls all the time of people who say, we see a lot of opportunity right now in consumer because we think valuations are too low, and we think they're going to be coming up, in the not too distant future. So there's a
And
lot of that. And so
these are like growth equity companies, or also other brands on, I mean, on the buy side.
it's mostly, honestly, private equity
Private
buyout
equity. Yeah.
companies. Yeah. They're looking at valuations and believing this. It's a very good time. The problem on the flip side is, sellers also understand that, and they're not going to sell for a price that in a year is going to look like they made a mistake, right? In
Yeah.
our job, we're pretty
Exactly.
much
This is your
exclusively
job
sell
now
side.
to try to
Yeah.
facilitate that. Yeah.
Yeah, and we're sell side, and I mean, we just tell our clients like it is. We just tell the truth. Say, hey, if I were you, I would not go to market right now. If I think you can do much better in a year, my
Mhm.
advice is going to be to wait. If you still want to do it, okay, fine, we'll do it. But that my advice would be, to wait. So it's harder to get deals done in that environment, but you know, it's this. Yeah, I've been in capital markets and M&A for 20 years. I've
Yeah.
seen cycles, man. It all just comes in cycles.
Sure. Sure. So you've shared with us about revenue profiles, profitabilities, EBITDA, and valuations. What about diversity in terms of go-to-market channels? I mean, owned versus earned media, multi-channel. Is it? I'm sure it's also a factor here in terms of
Huge factor,
yeah.
especially now again because um, it's part of that overall story of being able to have brand um, predictability. So the more channels that you are successful in, the sort of, we'll call it, the better the foundation is for the company, for the brand. That's the perception from buyers. So
Okay.
if you're a one channel brand, one of the things, if you come to us, one of the first things we're going to talk about is how do we profitably and accretively diversify our channels? Like, where else can we go to prove that we're not just great at a channel? We actually have a great product and a great brand,
Yeah.
right? And I think that, that's for direct to consumer native, digital native brands. That's something they're going through now because most founders in that world, they're not used to working with retailers. So a lot of the products are regulated. So going international takes time. You have to
Mhm.
be, your compliance infrastructure has to be good. There are challenges to it. So it takes a little time.
Yes. Yes. What are the things that are influencing, the valuation? Um,
Besides the ones we've talked about, yeah,
yeah.
I would say the team is important, right? Because especially what was proven in kind of this brand aggregator phase of e-commerce
Mhm.
is that the team actually really matters. You can't just rely on, the fact that I'm looking at the data and the data tells me something. Like, I'm a data guy. I love data, and I use data to tell me things all the time about
Right.
what a company is. But the team really matters now. I'd say it matters even more. And people have realized that the people that are actually running these brands are really important, and the knowledge, the domain knowledge, is really valuable. So, and it's hard, right? Because for a lot of direct consumer brands, they run very lean teams, right? They use a
Yeah.
lot of contractors. There's not a lot of senior management because it doesn't work really well in the cost structure.
Yes.
So it's a challenge to say, I need to build a great team that I think will be a long-lasting team, but do it in an economically viable way. That's another thing a lot of digitally native brands are starting to try to figure out how to
Yeah,
do.
the fractional everything, right? Fractional CMO,
Yeah.
fractional CFO. I mean, there's a flourishing service providers out there, right? Providing this type of
Yeah, and
services.
it's great
Yes.
for the economic model in the short term. I think it's how you use it though, because what we always advise our clients, so we'll go through an income statement and say, I know you only pay this much for this sort of function for these people, but what a buyer is going to do is they're going to immediately double that. And they're going to double that because they know that they're going to run the business more traditionally, so they're going to hire a senior person to
Mhm.
run, at least that department. And so that's an exercise we go through a lot of being able to basically predict, when you give a buyer a P&L or an income statement, what are they going to do to it when they run it through their own model, right? And that's something a lot of times, again, brand owners aren't as aware of.
Mhm.
And we go through and, obviously our job is to strategically explain why, well, you don't really need that cost. I know you want to put it on there because it just feels more conservative, but here's why that's not, we don't agree with that, right? So that's part of what we do in
Yeah.
pushing back. But at the same time, it's what every institutional acquirer will do. They're almost always going to be layering on more people, especially on something that's run pretty lean.
Yeah. So, assuming that founders want to go into this process together with you and want to work with you together to find the right acquirer and go through this strategic growth process, where the founders need to spend their time, their day-to-day time. I mean, is there is any change or in terms of your expectation? I mean, they need to work and think more strategically, working with those potential acquirers and learn about them, or they just need to focus on the day-to-day. Does something need to change in the way those founders are operating?
Yeah, that's a good question. I would say so. There's sort of a general answer, and then there's a bunch of things that might be specific to the founder. So the general answer is when you start to get into the mindset that, hey, I'm working toward a strategic transaction in the next 1 to 2 years, a lot of times it is a little bit of a mindset sort of shift where now you do have to think strategically. You're moving pieces around the chessboard. You're not just in the day to day and only thinking about, sales and profit today and just, getting things done. That's why a lot of times founders they need help with that, like with people like us, because they're already so busy just running the day to day
Yes.
that they're like, I don't have time, or they may not have the experience or the skill set to really do it. So they kind of need that coaching, right?
Mhm.
Um, so that's one. It's you do have to move into a strategic mindset more than a tactical, but the tactical has to stay really good because obviously you have to perform, right? So I would say that's the general answer. The specific answer, and you probably fully understand this, like every founder has different strengths and weaknesses. What we're always trying to guide the founders to do is lean into your strengths, get help with your weaknesses, spend time on the things that are valuable. I know you might want to take the trash out in order to save a few dollars. Don't.
Mm.
Don't do that. Like basically spend the time where it has the most valuable. You are at your highest and best use. But that can be different. Some people are finance people, some people are marketing people, some people are product development people. So that's the other thing we try to do as well, is kind of build around the founder's strengths, and try to kind of shore up their
Yeah.
weaknesses.
It's much easier to identify your strengths than your weaknesses, right? And
Yeah,
one of the biggest weaknesses is ego, right? So how do you manage ego during this transaction? I think that's a really
it's
important topic to discuss. Maybe give some tips also to founders here.
well, I think first of all, I think when you're in this business as long as we've been, you're always, you just stay steady, right? There's a lot of ups and downs throughout all of this, whether it's leading up to the process or in the middle of the process.
Yeah.
It can be a roller coaster, but having someone experienced there by your side saying, Don't worry about it. It's fine. Don't get too high. Don't get too low. I think that's part of it. Like you being that steady sort of presence for founders is something we try really hard to do. The ego, yeah, I think sometimes, I think first of all, we build our relationships on what we would consider brutal honesty,
Yeah.
right? We're like, hey, let's get one thing clear. We're on the same team and we're all trying to work to the same goal. So I'm going to be really honest with you, and I want you to be really honest with me. And I'm not going to hesitate to say, "Hey, honestly, I think you're looking at this wrong, and I think that you're kind of you're off the rails on this one." I just think you need that for something
Mhm.
like this. You have to have that brutal sort of transparency and honesty. But then there's also some psychology part of this. Everyone, if you're an M&A, especially if you're an M&A banker and working with founders, which is very different than working with large companies, which I did early in my career for a number of years, where you're dealing with boardrooms filled with people and it's not a single owner. It's just a bit of a different thing. That owner is the personality, the things that upset them, the things that make them happy. They're all different, and so you do play a little bit of psychologist along the way too. That's for
Yeah,
sure.
for sure. So what you're actually saying is that there is a time for like direct, brutal approach, and time for maybe more psychological processing or a more
Yeah.
subtle type of process, right? To implement
Right.
the things that you want to implement, right? So that's an art. It's not something you can learn anywhere, probably from experience, right? That's
It's experience. I think it's also if you have to care, like because and if you really are passionate about this, you have to really care about it. If you do, it tends to God. If you're someone who's sort of you don't really care that much,
Mhm.
you're not probably going to be as in tune with when to do kind of different things.
Yeah.
And I think, look, I could be working with Fortune 500 companies. I did it early in my career. I'm choosing to work with founders because I really like it.
Mhm.
Right. And I'm also the kind of guy that I'm going to give you a kick in the butt, but right after I'm going to give you a hug.
Okay,
So,
nice.
you
Yeah,
know,
yeah, yeah. So Jason, with the increased focus on profitability, obviously it requires leaders that are more down to earth, going back to the basics, more type of operational type of leaders that are going to the details, analyzing every shipment, every warehouse, every 3PL RFP that they're issuing, or analyzing every ROAS or ROI on their marketing activity. And I'm very interested. To have your thoughts. What do you think about the leaders of today, right? With the increased
mhm.
focus on profitability. This is the first part of the question. And second part, if it's primarily a PE transactions, what is usually happening with those leaders? Are they still they want, some of them obviously want to terminate their employment or their engagement with the company, and some of them want to stay. So how this I think it's very, very interesting aspect of the discussion as well.
Yeah, and you're not wrong. In this kind of current sort of phase that we're in, with that focus on profitability and really how do we scale but do it in a profitable way? How do we maintain that? You do have to pay very close attention, right, to operational and financial details, closer than just hey, I just want to go out, I want to build a great brand, and I want to do a lot of marketing, and I want to drive a lot of revenue, and that's what I want to do. And eventually, it'll all be fine if the profitability will come later. Like, yeah, that was the attitude in
Yeah,
2020, 21, 22. It's not that way anymore.
yeah,
So yeah, leaders and that are able to do that and be more operationally focused are absolutely seeing more success, and they're more coveted right now because I would say again it's all cyclical, but currently the sort of I'd say what I hear a lot is that it's harder to find someone who can execute consistently than it is to find someone who has very interesting ideas,
ideas
right?
like
Big
the business
ideas.
side, right? From
Yeah.
execution to maybe dreaming, vision, long term,
Correct.
big
Right. The
plan.
execution is what's being valued right now. If you can
Exactly.
execute,
Yeah.
people are more interested to talk to you currently. And you asked about just the trend. Also, one of the lessons that I think has been learned, if we're thinking direct to consumer in particular, but these lessons have been learned at different points in different markets. But people in the last 3-4 years did learn, as I mentioned before, that the team really matters. The founder, of course, really matters. So you're seeing when companies are getting acquired, they want these founders and teams to stay around for a lot longer.
Okay.
Deals are being structured where those founders are being asked to be part of this, have real exposure, skin in the game, if you
Like an
will,
earnout plan or
earnouts or
that.
or just rolling equity, and say, hey,
Rolling
I
equity.
sold 80%, I rolled 20%. That's very much in favor.
Yeah.
On the strategic side, I mean, and PE is very much that way. Strategic, it's still, I'd say, more that way, but I'd say strategic acquirers feel a little more comfortable with their own ability to absorb, let's say, a strategic acquisition and not have it lose momentum in terms of performance. But still, I mean, I've seen it in small businesses and large businesses across every sector. It's just when someone builds a business, they just have an inherent knowledge base that can't be quickly replaced. You need to find a way to download that knowledge, and sometimes it can't be done. It just can't be done quickly. It has to be
Hmm.
done over time, and people have learned that different ways, right? But it's funny how eventually that always becomes the truth, even if it doesn't start out that way in sectors. We easily forget. We're humans, right? We forget the past pretty quick.
Yeah. So profitability now comes from like being very focused on the nitty gritty things, right? Whether it's a CRO, supply chain. I mean, any percentage of improvement has a direct impact on profitability, right?
Absolutely.
What are the things that if you can share a few tips for the founders out there in
Mhm.
terms of what are the important things to focus in terms of execution during these days, right? How can you sustain growth but also make it profitable growth?
Yeah. Well, first of all, again, it's a bit of a, I'd say, surgical exercise to go through. One of the things we love to do early on when we are engaged with founders is we go through their income statement, every line, and we talk about what's going on here, what's the structure of this. Whether, let's start at the very top, pricing for our products, right? Okay, let's say we're selling our product at $40. Why aren't we selling it at $45? Like, do we have a reason or not? What? Let's talk about it, right? And you
Yeah,
kind of work all your way through. It's like, well, when's the last time, you're buying 4 times as much from your supplier that you did a year ago? When's the last time you talked to them about the cost? Oh, I have, a lot of you may be amazed. Most of the time it's like, no, I haven't actually talked to them about the
yeah,
cost,
no time
right?
or not. Yeah,
Okay, well, it's time. We were like, okay, you're now doing four times the volume, right? And you just kind of work your way down. So that's when it's being very meticulous and surgical about your entire structure, every piece of your cost structure. And
yes,
I think a lot of people get the wrong idea about that. They think it's like an accounting exercise. It's not even close to an accounting
no,
exercise. It is a business model structure exercise. How do I get my how do I create the right, like, most optimized model for what I want to do? And so that really is it's kind of these things that get taken for granted because as you're building a business, it's like the fog of war is what we say, right?
hmm,
There's stuff happening and eventually the years just peel off and you haven't really thought about a lot of these things. So that would be my first tip is meticulous strategic exercise. The other tip would be, especially if you're in your consumer, take a step back and say, what value am I really trying to bring to my audience? What is it? Right. And am I doing that in the way that I want to be doing it? Whether that's how I'm reaching them through channel, the features of the product that I'm giving them, the customer service that I'm giving them after they purchase, the follow up to say, hey, I want you to know I really appreciate you being my customer, right? Just if you were on the other side of the table and you really wanted the perfect experience with a company like yours, what would it look like?
Yeah,
Right. And I think that's the other one. It's those exercises and those kind of thought processes that are really, really
yes.
important.
Yes, obviously in the pandemic, I mean, you can just copy. I mean, if you're in a specific niche, you can just copy someone else and it worked, right? But now you need to
Yeah.
find your own identity. What's the secret sauce, right? That is differentiating you from others. Uh,
Yeah.
I
And
see a
that's
lot
the
of, yeah, yeah. Sorry, go ahead.
I would say, and you reminded me that, in terms of acquisitions from a buyer's perspective, that's another place that a lot of acquirers are just, I mean, really zooming in on is this a differentiated product or brand? And if it's
Yeah,
not, there's not a lot of interest.
sure. Look, a lot of brands are, or a lot of business models are less relevant, like private labeling stuff like that. I mean, just the cost to sell is very, very high, right? To acquire and bringing users
Hmm.
to your store, even to your Amazon store. I see a lot of brands are now focusing more on retention because it's cost less, right, to sell
Hmm.
to existing customers than to acquire a new customer. Obviously, like evaluating different sales channels, maybe Meta, Ross is not as good as it used to be, so they're trying probably go to like influencer marketing or try to be creative and try different things, experimentation. And if you're spending 35% or 40% advertising on Amazon, right? So you can probably share that profit with some other channels. Maybe go to TikTok and try to leverage there, and you can maybe grow organically. I think that the list is long. Plenty of things to do. Definitely, as you said, meticulously arrange, go starting from revenues and cost of goods, right, and all those operational expenditures that are relevant. And there is definitely place to improve, and even one small improvement like even 1% improvement on the revenue has probably 3 to 5 times impact on cost. So that's
Hmm.
very, very important topics. Um, Great, Jason. So if someone, brand owner or brands want to reach out, what is the best way to reach out to you?
Yeah, you can just email me, jason@gw.partners. So our website is www.gw.partners. Yeah, and they can just send me an email, and we'd love to chat. Again, our passion is working with founders, and we're always looking for ways to help. So even if somebody isn't a fit for us as a client, we always try to pass them to somebody that can help them if they're having an issue with whether that's say marketing, or whether it's they don't like their 3PL, or they don't like their Amazon agency, or whatever it is. I mean, we have a great network that we try to bring to founders, even if they don't become our clients.
Yes, and that's another important topic because operationally you can improve the service provider, you can suggest agencies for different tasks and consultant. That's part of the things that you do.
Absolutely. Yep, big part.
Great, Jason. Anything else you want to add?
No, man, just happy to be here, man. Excited for the rest of this year.
Yeah.
And I think, I'll sort of leave the audience with this. You know, when we look at the macro outlook for consumer, for M&A in consumer, is all, in our view, looking, upward as we get through the rest of this year
Mhm.
into 2025. We see all of those things trending. I know there's, a little bit of nervousness around the Fed with interest rates and inflation and trying to battle that. But everything we're seeing, all of the data is telling us that, over time, especially kind of on the M&A front, we're going to see consumer products companies continue to, kind of see more and more interest and activity. And we're already seeing it. We've seen a big uptick in the last month on the venture capital side for consumer. That's usually where you start seeing it first.
Wow. Let's talk a little bit more about that. So
Okay.
you're saying like minority investment in brands by VCs.
Yep. Seed
What
rounds, Series A rounds. You're just starting to see that pick up quite a bit.
what are the criteria? Is it more companies that are heavily invested in tech or implementing various AI
No,
or analytic
honestly,
tools? It's just pure business.
pure business, yeah, and I'd say
Yeah.
the two sectors we were talking about this earlier too. The two sectors that are getting the most attention right now are health and beauty, and food and beverage. So we're seeing a lot of the activity concentrated there. But honestly, in the last couple of weeks, especially, we've seen it be pretty diverse, right? And
Oh,
so I think what that's sort of showing you is that the venture capital investors are now saying, okay, we can see the next, we'll call it upcycle coming,
Hmm.
and we want to invest now in these really early stage brands that look like they probably could really take advantage of that. So it's we call that green shoots. It's kind of that early sort of signs that people feel like kind of that next bull run is probably coming pretty soon in consumer.
Wow, really interesting, and I'm happy we mentioned that because I think it's very, very important to highlight
For
that
sure.
early stage investment for sure, for sure. Great, Jason. Thank you so much. It was really, really
Thanks, Eitan.
pleasure being here. Thank you so much.
Yeah, it was great. Thank you.
Bye bye.